Well, good afternoon. It's very nice to be here. It's very nice to join this distinguished group of experts in the field. We're going to be talking about probably one of the most transcendental transformations in the history of finance, the transformation of the banking industry into a digital industry. And I'm very happy to be able to moderate this panel. I've done a long career as a banker and as a chief investment officer of a large insurance company. And I'm starting my own company now and trying to innovate. And obviously I have to focus on digital assets if I want to be part of the future of finance. Finance is transforming very quickly. Miami is becoming the epicenter of this transformation this month. We can see that trades in digital currencies are becoming more abundant than trades in traditional assets. Stablecoins are becoming more widely spread used around the world, and we're seeing a huge transformation that is based upon technology that seems to be largely superior to the traditional technology. And that's where my first question goes. I would like to sort of launch the question and let you talk about those issues, and we'll take it from there. What's going to happen? What's going to happen with the banking industry? Will it be totally replaced by a new digital banking industry? Or will banks become digital institutions? Digital finance hurts traditional banking where it hurts the most. It eliminates informational asymmetry. What do you think, gentlemen? Who would like to start?
I'll go. I think it's kind of silly to think that there's going to be a full overhaul and replacement of everything. I don't think it's realistic. And frankly, the traditional, air quotes, banking industry serves a lot of roles. It does, dozens and hundreds of things. But we're starting to see, everyone's been talking about stablecoins and how much more efficient it is to use it for trade and settlement and all this stuff. These things are complementary. They're not yes, they compete on some parts, and we've seen this with the debate in the Clarity Act, right? The banks don't want stablecoins to pass on yield because it encroaches on their business. But ultimately, there's going to be some sort of middle ground where these two things intersect and are compatible. And in a lot of ways, what we see with traditional kind of crypto and blockchain rails, it could actually make things more efficient for a lot of banking infrastructure, whether it's capital raising on chain or any of the dozens of other use cases. So I don't think there's going to be a wholesale kind of overhaul of everything, but these things can coexist.
But we just heard that Larry Fink believes that every asset is going to be tokenized at the end of the day. Don't any of you disagree with what we just heard?
I agree, but perhaps the way I would put it is that I think crypto and blockchain rails are a fundamental technological upgrade. And banking has gone through other fundamental technological upgrades in the past. And some institutions have made the jump and they survive and they're even stronger and dominate the industry today. Some just didn't make it, right? So if we think, go a few decades back and we think about internet banking, right? When we started to move from a physical asset service provision structure into a digital one, right? I do see crypto in the current iteration as a step towards that direction. I think we can argue that maybe it's a bigger step, right? Because I think we're fundamentally changing the rails upon where a big chunk of that industry works. And I don't know, I think it's interesting that, I do think the title of our panel, Crypto Banks versus Traditional Banks, is valid because we're here to highlight the differences and we're talking about this transition. We're at the very start of this big transition, right? But I also think that On the other side, there's also an aspect of crypto banks and traditional banks sometimes working together. And this is actually just a very good day for me to talk about this, because I work for Anchorage Digital, and today we just announced a partnership with BNY. We started to provide things like fiat USD interest for our clients. We started to provide things like global SWIFT access to our clients. So today we are moving one step ahead towards becoming this institution that within a regulated perimeter can seamlessly interact with both crypto assets and traditional assets. And we just made this in partnership with a very traditional bank. BNY is one of the oldest financial institutions in the country, if not in the world. So I don't know. I think it's hard to tell exactly what the end state is going to look like. We are in the very beginning of this transition. This is something that's going to take many, many years, maybe a decade plus, and I think it's still unclear who are going to be the winners, how this industry going to look like. What we do know is that there is a transition going on. I would argue it's an even deeper transition than what we saw with like internet and information technology in the 80s and 90s. We'll see how it goes. I think the most encouraging thing today is that we have a very well-established crypto industry, and a lot of companies like Anchorage, like many of the ones who are here, that have established footprint and are expanding towards a broader scope of finance. And on the other side, you also have a lot of the large banks that are paying attention to crypto in a way that they haven't just a couple of years ago. So I don't know. For me, I think it's going to be a transformation. I think we have a lot to learn from the traditional banking industry. They probably also have to learn a lot from us, and we'll see how the winners will look like.
Now, but if you look at the experience of institutions like Revolut or Nubank in Brazil, they are entirely digital institutions that are growing really fast, and they're taking over their markets. Why wouldn't that be the rule?
Look, following a bit what David mentioned, right, that is a transition. I think what's interesting on our side, right, I'm from Xapo Bank, right? So we actually started the other way around, right? We started as a Bitcoin wallet, right, and as a Bitcoin custodian around 2013. And then we grew from there to become a fully licensed bank, right, out of Gibraltar, right? So we really looked forward, right? We actually saw that in order to gain trust, right, also that we needed to develop, right, not only the regulatory framework, but also the services around crypto to be able to serve our customers, right? So initially we got the early adopters, right, Bitcoin holders as users. They were using it as a wallet, but then you need to give them some extra products, right? And this is where becoming a bank made sense for us, right, in order to give them, for example, they had Bitcoin and they weren't able to spend it, right? Or they needed to send a transaction or a deposit or earn, like send US dollars, right? That they couldn't do it at the beginning. Getting a licensed bank custodian as a custodian was actually the natural path for us, right? So, and I think this is where these other banks, right, like Revolut as well, they're also seeing that, right? In terms of they started as a traditional financial solutions, and they're adding crypto as an integration in order to be more open for the user.
Mm-hmm. What do you think?
Yeah, I mean, from our perspective, traditional banks will need to continue to evolve like any industry. They need to make sure that they absolutely remain relevant. I think what we can see from the Web 2 world, you touched upon a couple of examples there from digital native challenges like Nubank, Revolut, they have driven competition. They have forced the traditional players to improve their digital offering. A huge amount of investment has gone in since those players were formed in the market, a decade ago. And I think what we're seeing now, and you touched on, is the same, but in the Web3 world. We're starting to see big traditional players think, how do they integrate Web3 into their banking stack or into their operating model? And that's not just at the customer level, but that's also through compliance, risk teams, legal, and how they handle that across different markets as well.
But blockchain is operationally a much better technology than the traditional technology that has been used by banks over the years. How will blockchain change banking then?
I'll give a good example. So I used to work at a company called Stablecorp many moons ago, first Canadian dollar stablecoin issuer at the time. And there was a lot of like false starts, and we had all these go-to-market strategies and all sorts of stuff that was very much aligned with crypto exchanges. And I think this is a relevant example because it illustrates where things are going. So recently, they signed a bunch of partnership agreements with TD Bank, CIBC, a bunch of others. And the arrangement is such that they're going to be replacing some of the back-end infrastructure where banks are transferring Canadian dollars back and forth with their own stablecoin infrastructure. So the same way that this happens on many centralized exchanges where you could just like settle between accounts using stables or crypto or whatever, there's no reason why this can't happen in traditional banks, right? Like you have fiat sitting, in a vault or whatever. It's just numbers on a screen, and moving it around, T+2 or whatever the settlement times are, per institution. That doesn't have to exist anymore. If you have, either a tokenized, U.S. dollar, Canadian dollar, whatever, this is like the most obvious low-hanging fruit. There's no reason why now. I mean, there's a lot of like political and complicated business reasons why they wouldn't do this, but there's no technological barrier to doing that. And we're starting to see like some fruit, some of these companies bear fruit in this direction. So I think that's the most obvious thing. And like there's a lot of like if you think about why has outside of trading, why is like Coinbase, and Binance and Robinhood, some of these kind of bigger players, why have they attracted a bunch of like normie retail traders and users? Is because you can get yield on your deposits. So like what's the difference between me depositing 100K in Coinbase and getting 3 or 4%, and me keeping that cash in my account? The difference is I'm going to make 350 basis points less in my traditional account, right? So these things are attractive, and like people are starting to like wise up. So.
I think interesting point there. The technology has been there for a long time. It's not a technology problem. Banks have had access to this technology for the best part of a decade. Really, it's, as you touched on, everything that comes around it. It's the risk frameworks, it's the compliance. We know that banks and financial institutions are, as I'm sure you'll know more than most, very risk averse. And they often say that compliance and risk teams control the decision-making process, right? So it's going to take a lot for us to turn the tide. I think we're starting to see that in the industry at the moment. And what I particularly like to see, particularly coming to events this week like Consensus, is that we are not now building as a crypto or Web3 industry for the sake of it. We are building to solve real use cases. And I come across founders and projects all the time now that I'm thinking, great, yeah, I can take that and I can really use that when I'm building a new product. 3 or 4 years ago, I couldn't do that because either the security wasn't there, there was no sort of commercial focus, it wasn't really solving a genuine problem.
Mm-hmm. Yeah.
I think, I fully agree with everything here. The one thing I would do, though, is take like a step back and think about what the technology actually provides. On one hand, of course, this is kind of a new asset class, and you have Bitcoin and ETH and Sol and all these new assets that you can provide trading capabilities to your clients. A lot of companies have been doing that. But from a more fundamental aspect of how banking rails work, I think there are some very important innovations here that they were touching into. And just to bring a high-level kind of framework of how that works, I like to think about those things as first, faster settlement. And this is basically what things like stablecoin provides. This is what things like tokenization will provide. There was just a panel on tokenization and talking about like all the interesting things that we might see ahead. But the main benefit that we're seeing here is replacing this very nested layers of intermediaries with a much faster settlement process. So that's the first thing. The second one, which I actually think it's still somewhat under discussed, and I totally understand that it's coming further along, is the programmability aspect that you can bring with these rails, right? So this is where DeFi comes in. This is where things like decentralized exchanges, decentralized borrow-lend protocols, and all these amazing protocols that we're seeing in DeFi. So when you bring these two things together, the faster settlement aspect and the programmability aspect, I think you're talking about fundamentally different rails. So just to go back a little bit to your first question, I think provision of financial services will look very different 5 or 10 years from now versus it is today. We're in the very beginning of this transition. Whoever makes the leap will survive. Those who doesn't will probably be left behind. But that's how I think these are the two things that crypto rails actually bring to the table for from an operating financial service standpoint.
But if we all agree that finance is going to be dramatically different in 10 years, and we know that the technology has been around for at least a decade, why has it not yet happened? I mean, what's in between? Is it the customer? Is it regulators? Is it risk aversion? What is it?
I think, oh, sorry.
So yeah, I think it's a mix of both, right? Of course, first of all, there needs to be everything around a regulatory framework, right? And then, yeah, there are some institutions that need to take a bit more risk. But I think you mentioned that it might come in 10 years. I see that happening now already, right? I see that happening in banks even that are actually integrating, you know, the settlement layers of stablecoins, right? I'm actually from Argentina, right? So the banking system is horrible, right? So I actually see there banks actually integrating B2B stablecoins for B2B transactions, right? Where, I don't know, a transaction before used to take like 3-4 days, right? Now it can be even done in the same day, right? Mm-hmm. Argentina, Brazil, and there are examples there for B2B settlements or even remittances, right? That's something that's already happening, right? So the technology is already integrated. And then something that I'm also very excited about is like how to improve capital efficiency, right? We see banks already tokenizing the money market funds. There are some other panels prior to this discussing about that, but these banks allowing this, you know, other firms to actually buy those tokenized market funds, put it as collateral, to then trade, right, and be more efficient with your capital. That's something that we didn't see that even a couple of years ago, right? So that's happening now. And there are big banks, you know, like very well-established banks doing that. So that really gets me excited about what's happening now, and it will continue evolving, right, in the future.
But it's not only faster settlement. It's today, if you want to settle a trade, you need 4 or 3 or 6 parties involved: custodians, correspondent banks, exchanges, broker-dealers. You don't need them if you use blockchain. Why doesn't this happen faster?
Because it disrupts all those players.
Okay.
There's a lot of like entrenched interest, and just look at how like stocks are settled, like how many layers just to like move a stock certificate, you know? There's a lot of old interest, and they have a lot of money and lobbying power and influence, and that's just part of the process, right? Look, I think also, like, let's be real, there was a lot of like terrible stigma around the industry. There still is. Like last month was the worst month in terms of hacks, right? We can't get away from that, right? So, you know, if you talk about, oh, I want to put a tokenized money market fund into a DeFi pool, like, okay, like now you're opening yourself up to like Lazarus Group hacking, you know, your entire protocol, right? So there's all this other stuff that needs to be sorted out from like an optics and security perspective. And like, you know, we all know there's 1,000,001 security audit firms, but that shit doesn't matter anyway, because like most of these things were already audited and they still got hacked, right? So yeah, I mean, it's going to take time, right? But like, you know, BlackRock and all these other big players that have come in over the last like cycle or so, like it de-risks the process. When you have Larry Fink shilling our bags on CNBC, like it's great. And then they move over to, oh, by the way, we want to tokenize this and tokenize that. So it's just like, it's just, to me, it's part of the process, right?
I also want to highlight the regulatory aspect here. You know, crypto years, sometimes they feel very long, meaning the industry moves very fast. Sometimes they feel very short, like we wish the industry was moving faster. That can obviously be stressful for whoever works in. I didn't have white beard in the picture here when I started in the industry, so like it can be pretty stressful when you're living this 24/7. But I think we have to remember that we had a regulatory framework that was almost openly hostile to the industry until, less than 2 years ago. And a lot has changed. Of course, we had one landmark legislation that took place in the US, which is the Genia Act, kind of putting out the framework for stablecoins. Now we're potentially, I would say, I hope we're on the verge of having the second legislatory milestone, which is the Clarity Act, the market structure bill. There's still a lot of ongoing regulatory discussions. For example, if you're an OCC chartered bank, which is our framework and probably the preferred framework that most companies want to operate in the industry, if you want to be in the intersection between crypto and banking in the US, how you think about Fed master accounts, right? So I think there's still a bunch of hurdles and a bunch of loops that we still need to go through. Besides the technical challenges, I fully agree with that. Like, I think it's also important to keep in mind that imagine if you were a large GSIB and you want to start to engage with crypto, build a crypto custody platform. This is a thing that takes years. I mean, we've done this. A lot of folks here in the industry have done this. These are ultimately bare assets. So it's a fundamentally different architecture from what we had before, and the technical challenges are meaningful. So I don't know. I think I wish, I'm sure everybody here wish that all the banks were already operating on crypto rails and connected to Hyperliquid and doing lending with Morphle and all those amazing things. We as a firm have enabled a bunch of integrations like that. But I do understand that there is like not only the regulatory clarity that is evolving, but also the technical challenges of doing that, and we want to do this in a responsible way. So I understand that things are moving the way they are, although everybody would like to see them move faster for sure.
Yeah, I mean, what the regulation does give us for the first time really is a clear set of guardrails that institutions can operate by. Without that, really, we were never going to see the adoption that we're searching for. But I think, and as you touched on there, the regulation, and we have MiCA in Europe, right, which is already over a year old now, and we're taking the first learnings from the implementation of that iteration. There's also, we haven't battle tested yet what happens in financial institutions. We always tend to think of what happens when things go wrong. How do we manage that situation? And the accountability, if we move everything on chain, you touched about those intermediaries. Okay, great, we take out some of them potentially, or their roles are redefined, but who is responsible for what and at which stage of the process? Because ultimately, if it ends up in court, there has to be a person accountable. And if you go to the true origins of DeFi, you'll struggle to find someone that is ultimately accountable. So I think this is where the convergence is happening, and I think that the other panelists touched upon this TradFi versus, the very nature of the name of the panel, right? TradFi versus crypto. I think we've moved on as an industry. It's not TradFi versus crypto. It's how we can come together and take the best of both worlds to create something that is ultimately better for consumers.
And what will the financial institutions of the future look like? Will it be the JP Morgans and the BlackRocks, or will it be the Googles and Apples that run the financial system in the next 15 years? What do you think?
I think it's probably going to be a mix of those things, plus the Anchorages and the Xapos and the AMINAs of the world. I think the field is open, and that's why this is such an interesting time to be in the industry. When you have these massive transitions going on, that's when you can really catch up and become a dominant player in a much broader industry, and I think that's what everybody's looking for. We'll see how the final form of this new bank will look like. I think we at Anchorage are definitely building towards that. And so far, I think there's a few a few guardrails that I think are becoming kind of relatively clear. So like a lot of these firms, for example, operate on a full reserve system and not on a fractional reserve like the traditional banks do, right? A lot of these firms have some sort of kind of qualified custody off balance sheet component in the sense that the user owns the asset in a different way than it does in a traditional bank. And perhaps the other component here is that you should be able to move seamlessly between fiat and crypto. So like some of the guardrails I think are starting to become clear. A lot of these are things that we are building towards, and we'll see how it evolves from here. But I'm sure that there's going to be a couple of the traditional finance companies that will be successful in making this transition. Maybe some of these large tech companies are going to take some of the pie as well. And you're going to have new emerging companies, crypto native companies, even protocols maybe that will become massive players in the system. I'm very sure that we're going to see those. And I would even argue that today you kind of see that, right?
Mm-hmm. What do you think, gentlemen?
I'll answer this in a different roundabout way. So, and it also touches on the last question. So there's some things and some innovations that happen that are like forcing functions, like from crypto into TradFi. So like the most obvious example, which Pyth Network's very involved in, is the hyperliquid HIP-3 markets. So for those that don't know what that is, those are basically all of the non-crypto perpetual futures that trade on Hyperliquid. They're powered by various deployers, aka other projects, but they trade on the Hyperliquid front end. So, you know, all this talk of like 24/7 oil and equities and gold and silver and all this jazz, like we power all that data in the back end because our business is data and we're very good at it. And we figured out ways to be able to price things in off hours, right? So like regular trading sessions are pre-market, the actual session, post-market, and overnight. So we have ways to collect that data, aggregate it, and create a composite feed that then guys like Hyperliquid and others could use. And so this has been like the talk of the town because everyone's like, oh my God, well, like what's going on here? How are people trading gold on the weekend, right? Because this is such a foreign concept to everyone, right? And so now why this is important is that, you know, you'd be shocked the type of, you know, banks that are calling us that are like, hey, what the hell's going on here? Like, who's doing what? How are you pricing this? Like, what's the, you know, price discovery and all this stuff? So like, my point is like these forcing functions will get them to the table, and like what they do afterwards is anybody's guess, but they're curious. And my guess is they're going to not just sit on their hands because they see, you know, WTI and gold and silver trading billions of dollars on the weekend, and they're like, holy shit, we're missing out. So stuff like this will get a lot of the big guys to the table, especially the ones that are like very turbo focused on like trading as one of their primary verticals. But you know, there's probably going to be more to come, and like it's still, you know, it feels weird to say, but it's still early.
Mm-hmm.
Yeah, my side, I definitely think there needs to be there's going to be more integration, right? And we're seeing at the moment, we saw ourselves, right, starting on the crypto side and then moving towards, you know, the regulatory part as a licensed bank because the demand is there, right? The demand coming from our crypto users are actually demanding more traditional, you know, ways to use their crypto, and the same on the other way around, right? Big banks are also having the demand, you know, for more crypto products. So there's definitely going to be there some integration and the bridge between both worlds, right? So we'll definitely see more of this coming up.
How about geographically? Will it be, you know, large banks integrated throughout the world? Do you still see the same geographic fragmentation that we see today? I mean, geographic barriers aren't that relevant for, say, e-trade or e-commerce. I mean, will that change the financial industry?
I think what I would say from a geographical perspective and how we look at it from a product side is that, and we can look at this if we look at stablecoin adoption. Okay, so stablecoin adoption, we have seen a rapid rise across the US in the last 12 months, not just backed by Genius and Clarity, but because it's solving a genuine underlying problem, right? We haven't seen the same adoption growth in Europe. And that's because Europe has a payment system called SEPA that goes across many different countries across Europe that ultimately works. It is fast, it is low cost, it is efficient. So we're not replacing anything new there. Here within the US, I know many panelists across different events we've been to today still talk about the astronomical fees, how long it can take to move money even just between two US banks across states. So that's why we've seen stablecoins as a killer use case here really, really take off. So banks will need to adapt. What works in one jurisdiction will not work in another. That's the same as we see in the Web 2 world, but particularly in Web 3. And likewise, what we see, for example, from our APAC clients, there's demand for additional leverage, there's demand for higher yield returns than maybe some more of our conservative Swiss or European-based clients. So they will need to adapt and adjust their Web 3 technology the same as they would for Web 2.
And I don't know how we're doing about time, but are we okay? Okay. How about, do you agree with this? As the process of settlement and banking becomes more efficient using blockchain, there will be less need for capital in the financial industry. Is that good? Is that bad?
I don't know if that's true.
Okay, all right.
Listen, we're just improving the way the money moves around. Like the velocity of the money is still, I think, going to remain the same or increase. We're talking about geographies in the last question. Like once you get more people online, they're going to be more active, they're going to spend more, they're going to move more money around, So I don't think there's going to be less money movement. I just think that the efficiency is going to be different, and you're just going to open up additional use cases, right? And if anything, I actually think it's going to be more, right? Because and forget about just the developing countries where, stable coins are a lot more efficient in terms of saving money and moving money around. Fine, that's we all know that it's a great narrative and it's 100% true. But think about people that come on chain and people that discover new protocols to play around with, or they figure out, oh, I don't need to spend $100 to send a wire transfer. I could just move it from this wallet to that wallet, right? These things unlock new possibilities and ideas. So I think ultimately it leads to more capital and more capital velocity, and also just the world's moving like this right now. Even just look at the capex spend in just AI, trillions, right? So and it doesn't necessarily intersect with our industry too much, but there's going to be some spillover and crossover, right? We have no idea what's going to happen, but I feel like there's going to be a lot more of it, in my opinion.
Yeah, I want to fully agree here. There's this concept of Jevons paradox in economics that kind of, I think, speaks to this a little bit. You start to unlock all these use cases. And what I would add on top of this is that we're moving towards a world where maybe a lot of our financial transactions are not even going to happen between humans. They're probably going to happen between AI agents. So there's this whole agentic commerce kind of road ahead. And I'm very excited to see the new use cases that are going to be unlocked by these extra efficiencies. So I also am not sure if I agree that you're just going to need less capital, or whether you're going to unlock all these new use cases that we were not aware of before, and that we're actually going to end up with an industry that is even bigger than what we had before.
Excellent. Well, I think we've run out of time. Thank you very much, gentlemen, for this very enlightening discussion.